We've worked our whole lives, saved and invested just to achieve financial freedom, and been led to believe that instead of painting the perfect financial picture, everyone's plan is the same. But the truth is, no one is like you, and you deserve a financial strategy just as unique as you are. How do you navigate the complexities and volatility of a financial environment that just never sits still? And how do you find the guidance you need? Who do you trust with the wisdom to paint your financial masterpiece? You've arrived. This is the Wealth Council. Welcome to the Wealth Council. I'm Brad Johansson, where we present the Council's knowledge on your wealth. Appreciate you being with us today. Advisors from all around the country. Brian Caranta from Pittsburgh, Pennsylvania. Stuart Willis from Arizona, Colorado, Nevada, and Chance Robinson out of Orlando, Florida. Gentlemen, always a pleasure to be with you. I want to talk risk to start this one off. And this is a term that we haven't really quantified at this point. It's certainly not a term of art, where in the medical field or in the legal field, when you say a word, it means the same thing all across. In the financial field, if we're talking about risk, Brian, is there a way to quantify what that means financially?
Yeah, it's very simple. How much money can you afford to lose? That's risk. And the way we define risk, a lot of us up here, is if it go up in value or down in value, it's risky. Now, Wall Street will tell you that there's all these different levels of risk, right, based on how you allocate. But the bottom line is that if it can lose money, it's risky.
Yeah, absolutely. I agree. And look, even the most conservative people over the last couple of years have thought they were conservative, right? They thought their investments were immune from volatility.
Considered themselves such.
But those are the people that got hit the hardest because of the interest rates that have skyrocketed here. The long-term and short-term treasuries have gone through the roof, and that's absolutely cratered bonds here.
Well, when you're looking at these situations that people come in and are talking about risk, a lot of it has to do with the advice that they're given, right? And I got a very common rule of thumb when I sit down in front of a client. It's simply this: protect what you can't afford to lose.
That's right.
If I am sitting in a position that I can't afford to lose 30, 40, 50% of my portfolio, then don't have that much at risk.
No, it's just precisely why, you know, when I was in Las Vegas a while back, I remember watching somebody at the craps table. And it was interesting because their reactions, it was very clear, transparent to everybody, that person couldn't afford to be risking the money they had at the table. Yep. Because other people that were losing were having a great time. This person looked like everything was on the line. And I think it's the same thing with retirement. Don't gamble with the money that you can't afford to lose.
Yeah,
Let that change.
I think also, you know, if you look at what Stuart shared in regards to the people that were the most conservative actually lost the most. I mean, I think it was last year, the year before, the 20-year Treasury was down somewhere around 20%, 20%. I mean, that's a big loss to take when you're in what you would consider a very safe investment. And there's a lot of people out there that thought they were protected and weren't because of the rising interest rates.
How do people who are sitting in a position of saying, I know who I am, I'm conservative, I'm not going to jump out there and be risky, and sit with that position because someone has told them this is a nice conservative portfolio?
Yeah. I mean, here's the interesting thing. Like, there's a lot of ways that people mess up their investments, mess up retirement. At the top of that, we believe you need to have a tax plan. Number two, we believe you need to be in the proper portfolio for you. Forget what your neighbor said. Forget what the smart guy at the country club, your drinking buddies, all the smart people, forget it. Because people, you do not need to keep up with the Joneses. It's important how you're invested and that you're invested properly for yourself. But we believe that the most important determinant of whether you're going to succeed or fail in retirement is how you react to the markets. And remember, in order for you to react properly to the markets, because look, everyone knows you're supposed to buy low and sell high, and oftentimes people do the opposite, right? And the reason is because they're in the wrong portfolio for them. They're taking too much risk. And you need to understand truly how much risk you're taking and how much you're comfortable with.
If we know that this is the formula, buy low, sell high, and you're telling me that most people are doing the opposite? How do you find that most people are doing the opposite?
Well, because they're usually bailing out of the markets at the wrong time because they're risking money they can't afford to lose. With a proper plan, you should be able to hang through market volatility. The problem is when you risk 100% of your life savings, you're talking 30, 40 years of work that people are being convinced to risk, right? They should not be risking 100% of their life savings. Most people that are retiring today can't afford to do that because they need to live off of that money for the rest of their lives in the form of income. So if their portfolio starts to go down and they plan on living off of that and they're taking money out, they are compounding losses, they are locking into losses, and this is when they'll get frightened and sell at the wrong time because they're afraid of that account balance going to zero.
Here's what I get. This is maybe another term of art that's a little waffly here. The long haul, we hear, Chance. I'm going to be in it, or I have a guy that tells me I'm supposed to be in it for the long haul.
The thing that's interesting about that commentary is, you know, when you sit down, how many of you, you know, out at home have heard, oh, it's a paper loss, don't worry about it, it'll come back, right?
Right.
And in the funny context to me, I'm like, we can all put this into a really simple context. If we all had $100 at the table and we're sitting at the blackjack table, I'm a blackjack guy, right? And my 100 goes to 2, and then 2 goes to 3, and 3 goes to 4. When's the best time to get off the table?
Right.
We all know it, but what does everybody do?
Yeah.
Oh, I'm on a roll.
Yeah.
I'm hot. You know, I can't
going.
lose. And then what happens? If you play long enough, the house always wins. The market is the same thing, right? It works the same exact way. We understand that. So when I say protect what you can't afford to lose, don't play with what you can't afford to lose. If I'm sitting in this situation and I know if I lose 30% of this, if I lost 30% of that $100, right, what do I got? I got $70 left, right? To get back to 100, what do I need to get back? It's not 30% because 30% of 70 isn't going to get me there. I need a 43% return to get back to 100.
Yeah, right.
So the question is, when we look at the context of how the market really performs, when we see that 30% drop, what is the average investor really earning, and how long is it going to take to get back to where you're at today?
Well, you know, it's a valid point. And I think the good news is that now we're starting to see interest rates spike, right? We're seeing all-time highs. Basically, we haven't seen this interest rate environment since 2007, I believe it was, 2006, and for the 10-year Treasury. The good news is that it's a great time to start considering refinancing your retirement, because now that interest rates are high, for those people that can't tolerate the markets, that can't tolerate volatility, there are safe places now to put your money long term at some of the greatest rates we've ever seen.
And it's not whether or not the markets will come back. I mean, the markets do come back over time. The question is, are they going to come back in the time period you need it to come back in, when you are going to need your money the most? And that's the mistake we see most people making. And remember this, it's really easy to tell somebody to take risk with their money, especially if they get paid a fee or commission to do it.
Correct.
You know what your risk tolerance is? Why is knowing your risk tolerance so important? Is your financial advisor's idea of risk the same as yours? And how do you know? Find out where you stand. Receive your personalized Wealth Counsel risk report right now. And all you have to do, call the number below or scan the QR code. The Wealth Counsel returns after this.
Focusing on the financial aspect of retirement is important, but how does the change of pace in life affect you emotionally? After this.
Are you preparing to make your retirement funds work for you while not taking too much risk? While there is no substitute for sitting down with an independent financial advisor, why don't you learn the strategies of investing as well? Call for your free retirement investing guide from the Wealth Counsel right now to learn about investment strategies that align with your goals. Call for your free retirement investing guide from the Wealth Counsel right now. 844-463-3466. That's 844-463-3466.
Welcome back to the Wealth Counsel. I'm Brad Johansson here with Tom Mosley out of California, Prashant Sabapathy out of Baltimore, Maryland. Gentlemen, we just finished the last segment in the other studio talking about risk management, risk tolerance, people becoming scared. I think it takes us into this emotional part of financial planning where people really aren't prepared for some of the emotional changes, or really aren't necessarily, you shake your head before I even finish the sentence, emotionally unprepared for what they're in for right now. Why do you shake your head with that?
It's the twilight zone. I mean, it really is. It's not the twilight of life, but it's because it's going to be 20 or 30 years for a lot of people, but it's an unknown. They've from the time they were in kindergarten, they had something to do from Monday through Friday. They went to school and then they went to work in general. Or
This was their identity.
They had a pattern. And then when they break that pattern, I had one couple one time told me, they said, I used to spend a lot of money on Saturdays. And now I go to Home Depot every day and I go to Michael's every day and we spend a whole lot. So there's a whole different pattern in retirement because every day is a holiday. So it creates a lot of discomfort because we are creatures of habit if we're anything.
And that may be a form of, I've always had structure.
Yeah.
Mm-hmm.
And now it's so unstructured, I'm emotionally unprepared for what the risk may be going down the road. Am I tying those two together in the wrong way?
No, I think you're exactly right. I mean, it's absolutely a disruption of lifestyle. And so we're creatures of habit. And anytime there's an interruption to that, it's almost like a big culture shock that we have to readjust and get used to. And so one of the things that we always talk about, at least in our practice with the folks in Washington, D.C. and Baltimore, is why not try to test drive your retirement a little bit? Instead of just going from working full time to being fully retired, why not scale into that, ease into that, adapt to the lifestyle so that you can have a really better understanding of what life may look like? I think that's a great way to ease into it without really creating that culture shock.
Tom, you've actually been in the ministry as well as being in financial services. Is there something that correlates with a faith-based lifestyle, an understanding of where we are, and moving into another world that kind of correlates? We need to understand that we're going to be different and it's okay to be a little bit uncomfortable with a new financial plan?
I think that's true. When you take it on a faith basis, the Bible tells us very little about heaven because that's the uncertainty in the future. We know it's going to be great. And I think retirement can be great, and retirement is great for people. But if you add the biggest uncertainty, I think, with the people that we run into in California is, where's my income coming from? What kind of solid income? Because every single 2 weeks, 1 week, 1 month, they got a what? They got a paycheck. That's right. And so that uncertainty, if you don't have a written plan that lays that out, and that's the foundation of a good retirement plan, is where's my income coming from? And if you don't have that in place,
people are thinking that their income's coming from their savings.
Oh, yes.
I mean, that's what they think. And, at the end of the day, it's just about money in, money out. And when you retire, it's all about where the money in is going to come from. If it's not coming from a paycheck, it's got to come from things like Social Security. If you're fortunate enough to have earned a pension, it comes from that, or your retirement savings. And the key to the whole thing is alleviating that concern that retirees have of, am I going to run out of money? And so when we talk about putting together that income plan and really having that plan in place, it's about how do I create the paycheck that I want, but eliminate or really mitigate that risk.
If we create a plan, can we create emotional peace?
Well, the emotional peace comes, the reason I do what I do is because of the sigh. And here's what I mean. When you sit across the table, you've done it too. You're on the other side of the country from me, but you've done it too. Because you sit down with those people who come in and their major concern is, can we afford to retire? Which means, well, we have enough income, which means, well, when one of us is gone, if they're married, will it still be there? Will it last as long as we do? And when we create that plan and we build a plan out of the 401ks and the IRAs and the other things that they have, and we put it together and we really address income, and the sigh, they sit across the table and they go, and I know they've got it.
Yep.
You know what I'm talking about?
I know exactly what you're talking about. It's all about the income. And when you have more income than you actually need on a monthly basis coming in, nothing can really throw you off financially. I mean, life's going to come at us, but you'll be prepared.
So you can plan for an identity change and you can plan for an emotional change. Call the number below. Receive your own Wealth Counsel written financial form. We're going to prepare that plan specifically for you, no stone unturned, in order to build a plan that's perfect for you. Receive the Wealth Counsel written financial plan by calling the number below on your screen or scan the QR code. And the Wealth Counsel continues after this.
Up next, from faith to financial, hear Tom Mosley's story about his faith called him to the financial services field. Stay tuned, you won't want to miss this.
Are you preparing to make your retirement funds work for you while not taking too much risk? While there is no substitute for sitting down with an independent financial advisor, why don't you learn the strategies of investing as well? Call for your free retirement investing guide from the Wealth Council right now to learn about investment strategies that align with your goals. Call for your free retirement investing guide from the Wealth Council right now. 844-463-3466. That's 844-463-3466.
Welcome back to the Wealth Council. I'm Brad Johansson with the Advisor Spotlight today, Tom Mosley. Tom, we're coming out of a segment where I may have broached something for some viewers going, really, he's a financial advisor, he used to be in the ministry. Can you tell us a little bit about what took you into this vein?
I did used to be in the ministry for almost 2 decades, and then some family changes I went through, and so I decided I got into the financial industry at that time in 1995, way back then.
That's
way
a
back
long time ago.
in the dark ages. And I remember when I first sat down with my 2 managers, I was working out of a little office in Pasadena, California, and they said, "Who do you want to work with?" And I thought about it for a minute, and I said, "I want to work with retirees." And they looked at me like I was crazy because they were thinking I would say doctors or lawyers or somebody that made a lot of money.
Wealthy area.
Right. And they said, well, why would you want to work with retirees? Remember, this is 1995, and the leading edge of baby boomers were just turning 50, and every financial advisor that was out there is not a retirement expert like they are now. And so I said, I want to make sure, because I had, in the church work, I'd been in charge of benevolence many times. And I've had people stand across my desk, sit across my desk, and they were trying to decide to buy food or buy medicine or something else that was essential. They didn't have enough money for both. And I said, I want to work with retirees to make sure they never run out of income the rest of their life. I backed into my mission statement for my company, but that was the core of what I wanted to do.
But in the core of that, you're starting as the people who are looking sideways at you saying, why would you want to do this for people that are not there yet? What have you learned from 95 till now in the benevolence area of trying to deal with people in retirement?
I've learned that you can't wait till the last 2 minutes of a retirement plan, like the last 2 minutes of a football game. You can't wait till those last 2 minutes and decide to put the plan together all of a sudden. You've got to work on that plan along the way, and you've got to develop it so that when you do get to that retirement age, what I call the retirement red zone, being an old football coach.
Heck yeah.
Okay, I call it the retirement red zone because that's the time. You can't be 35 points behind in the last 2 minutes and catch up. You've got to start building a plan along the way.
You said something earlier about the people that you were dealing with were moving into an area that they didn't know before, and you were trying to figure out how to help them along the way. What's the change in that time frame for you about finding that peace at the end of the journey?
Well, finding peace has to do with tying last segment with this segment, with finding certainty, with finding the fact that you have confidence that what you're doing is going to work. I mean, if you know that you're starting to lay the groundwork to collect what I call the lumberyard during those 20s, 30s, 40s, even into your 50s, you're just collecting the lumberyard. You're accumulating, and when the market's down, you buy more. But when you get into retirement and the market's down, you're having to take more out. So having a plan that gives you some certainty that you're going to have guaranteed increasing income for the rest of your life, that brings such peace of mind, that brings such certainty, and then you'll know whether you can buy food and medicine or maybe one or the other.
Sounds like you have found the joy in doing that because you've been able to direct people along that path.
I will work as long as I'm able to work. People ask me all the time, how much longer are you going to work? I will work till that doesn't bring me joy, and that brings me such joy to see that contentment that comes to people when they know they have a plan.
Tom Mosley, thank you. The Wealth Council returns after this.
Is legacy planning a burden for only the wealthy? The answer may surprise you after this.
Are you preparing to make your retirement funds work for you while not taking too much risk? While there is no substitute for sitting down with an independent financial advisor, why don't you learn the strategies of investing as well? Call for your free retirement investing guide from the Wealth Council right now to learn about investment strategies that align with your goals. Call for your free retirement investing guide from the Wealth Council right now. 844-463-3466. That's 844-463-3466.
Welcome back to the Wealth Council. I'm Brad Johansson. Gentlemen, always nice to have you with us. And we're talking about something that goes to the end, maybe, of the retirement plan, or some people actually believe goes opposite of the retirement plan and may be confused. We're talking about legacy planning. We want to show that we've had a successful life. We want to continue to move that forward to the people that we love once we're gone. Stuart, if I ask you about legacy planning, do you have most people coming in on a legacy plan who have figured out the whole retirement legacy plan together?
No, I mean, honestly, it's one of those things that people just procrastinate on. They know they need to get it done. And look, I've been proposing people getting their estate planning done now for 20 years. And to the truth is, I'm a bit of a hypocrite because I just got mine done last year.
Oh boy!
Right, and right. I always say, do as I say, not as I do. Right, just to be clear,
you procrastinated like everybody else.
Everybody else does too. So it's a human instinct to do that. And I think one of the important things to do is just to make sure the whole purpose of an estate plan is to make sure you have the people in charge that you want in charge and that you're giving your money to the people you want to give it to. You don't want to let the states determine who gets your money. And you don't want the attorneys involved because they end up just eroding tons of your life's work.
Yeah, well, not only that, but you don't want the IRS to become the largest beneficiary of your money either.
In what way?
Well, so take retirement accounts, for example. I mean, if you don't properly handle the distribution of your retirement accounts under current tax law, the entire balance of your retirement account become taxable. So imagine this. There was an article in Money Magazine about a father who had passed away. His son inherits his IRA account. His son knows nothing about how to properly inherit the money.
Okay.
The son takes the money as a lump sum, $500,000 lump sum, and winds up owing the IRS over $240,000 in taxes. We're talking about almost half of the IRA wiped out in taxes alone because Dad didn't set up the beneficiaries correctly. And beneficiary documents come on retirement accounts, 401ks, 403bs, 457s, IRA accounts, Roth IRAs. If those are not set up correctly, and that money does not go to the beneficiary of your choice, or the beneficiary takes as a lump sum, you're talking about the IRS becoming the largest beneficiary.
Look, we ask all the time. In a previous show, you asked me the question of, why should you hire a financial advisor, right? Why not just, the do-it-yourselfers want to do it themselves? And here's the issue. The mistakes can be incredibly costly. Yeah. Like Brian just said, listen, if your beneficiary doesn't have somebody guiding them, they may just check lump sum, right? A lot of people don't take payments. They don't understand the implications. And look, we make a real clear commitment to our clients. And what we tell them is, I promise you, I will be there for your surviving spouse. We will be there for your kids. Yeah. But you have to have your stuff in order. You have to have your affairs in order. And a big part of that estate plan and legacy plan is the living trust itself. It's a huge part of people's estate
So
plan.
how common is this case of $500,000? And it may not be $500,000. It may be more. It may be less. How common is it that somebody is leaving something to someone, that son gets, oh my gosh, my dad gave me $500,000. I'm in great shape. And now 6 months later, I'm in trouble.
Yeah. Well, it happens more than you think, and that's because most people don't understand how important that beneficiary document is. How about this? You lose your spouse later on in life, right? And you get remarried, and you now name your new spouse as the primary beneficiary in your retirement account. You die, that new spouse that you just married now legally owns 100% of that money. That new spouse can disinherit your children because that new spouse can change those beneficiaries to whoever they want. And this is why a good estate plan could prevent that from happening, to make sure that the monies get to your loved ones.
And we hear all the time about these kids that are successful on their own. They don't want my money. They don't need my money. Look, if you want to see the Jerry Springer show, come to my office during an estate settlement here, right? The first time I was showing my mother-in-law my new office in Arizona, We had a guy peeling out because he was like peeling out donuts because he was upset he was disinherited. And I'm telling you, have your affairs in order. Let the document speak.
Yeah, I threw those numbers out. Isn't there a thought that this estate planning stuff is for the wealthy or the ultra wealthy?
Yeah, well,
I don't need that.
Well, you would think that, but everybody needs an estate plan. You know, even someone with a small amount of money at least needs a basic will. There's a lot that goes into it, and to make sure that it's done right, your financial advisor, your estate planning attorney, they should all be on the same page. The biggest mistake we'll see a lot is the estate planning attorney's doing one job, the financial planner's doing another, and the left hand doesn't know what the right hand's doing. And this is why you want to work with a good fiduciary firm that may house all of that in one place.
Mm-hmm. Stuart, Brian, thank you. Estate planning isn't just for the ultra wealthy. It's for those who want to leave a legacy for their loved ones. Learn about the 5 crucial estate planning documents that everyone should have in tax planning strategies. All of those and more will be included if you call the number below or scan the QR code. Receive your own Wealth Counsel estate planning guide. The Wealth Counsel continues after this.
Are you preparing to make your retirement funds work for you while not taking too much risk? While there is no substitute for sitting down with an independent financial advisor, why don't you learn the strategies of investing as well? Call for your free retirement investing guide from the Wealth Counsel right now to learn about investment strategies that align with your goals. Call for your free retirement investing guide from the Wealth Counsel right now. 844-463-3466. That's 844-463-3466.
Now, we've talked about the danger of unnecessary risk and the emotional changes in retirement. And planning to leave a legacy, it's why we do what we do, to make your retirement plan a unique masterpiece just like you. Now, I'm sure you still have questions. That's what we're here for, to answer them in a way that makes sense, with advisors who for decades have been helping make retirement last longer. For people just like you, who've been wondering, can I really do this? The answer is yes. Call now for an appointment or a written financial plan just for you. We're so glad you joined us. I'm Brad Johansson, and this is the Wealth Counsel.